Hello, folks. Brandon Chapman today. It is a video for Thursday, June 6, 2024. Yes, this is Blake's normal day, but Blake took my session on Friday, or my video recording on Friday, because I got jury duty. Man, what an interesting thing being involved in jury duty. I could go on and on, but I will not. Since this is not about jury duty, this is about what's going on in the market. I mean, my goodness. If we look at the ES, we're basically flat on today's session. If we look at the futures for today, a really interesting dynamic is the ECB, the European Central Bank, followed suit from yesterday with the Bank of Canada announcing rate cuts. Are we just beginning the process of seeing rate cuts globally? Central banks, they tend to a bird of a feather kind of scenario. Are they basically signaling that the Fed is going to cut rates? Well, all we got to look at is prices. So, for example, let's look at US dollar / CAD. The dollar CAD, try that again, / CAD. The dollar CAD, basically today, the CAD is strengthening vis-a-vis the dollar. If CAD is in the denominator, so if the price is declining, that means the Canadian dollar is strengthening. And you notice yesterday we saw the dollar strengthen and it faded, and today we're down. We're basically erasing all of the gains the dollar had after the Canadian, the Bank of Canada's announcement that they cut rates 0.25%. Very interesting, right? What about the European Central Bank, the Euro US dollar? You'd imagine the dollar would be strengthening against the euro, right? Wrong, right? Look at today. It now takes almost $1.09 to buy 1 euro, whereas yesterday was a little closer to $1.08. Point being is that the euro actually strengthened against the dollar today. Now, there's some interesting logic when we think about currencies and policy. There could be the possibility that people are thinking, investors or traders are thinking, that if they get out ahead of it early and cut rates earlier rather than waiting till they dig a deep hole, the policy will somehow not be as dovish, that rates won't go quite as low, that monetary expansion won't be quite as great. The reality is that scenario is always wrong. The fact of the matter is central banks do go to ZIRP. They do pump in and feed a lot, just expand the currency. And so the fact is that any cuts today is not going to prevent the abyss that's going to develop in the future, because we're in a pretty sticky time where fundamentals, the economy globally, it's not exactly where it was, say 10 years ago. And so the point being is that any policy response they're making today isn't necessarily alleviating any real concerns for the broader economy. But again, that's not why they're doing it. But why in the world is the dollar not strengthening? Is it possible that basically the world's saying, that traders are saying that the U.S. government, or the U.S. central bank rather, is going to cut rates sooner rather than later? Well, if we look at the Fed funds futures, the CME Fed probability tool, we can kind of make that assessment. Well, if we look at it here, this is September's meeting. We're looking at basically the first rate cut being priced in. We've got a meeting in July. We're seeing more of maybe a 20% probability of a rate cut. The first rate cut is really being priced in at greater than 50%, greater than 60%. In fact, we're close to 70% probability of a 1/4 point cut in the September's meeting. If we look out at December, you'll notice over here, for example, 4.75 to 5, that's about 50 basis points lower than the current rate. And we're looking at 41 plus 23 plus 3 plus 0.1. We're essentially looking at about 65% plus probability that the Fed is going to cut 2 times by the end of the year. That really hasn't changed dramatically, but it is different from where we were just a week ago and obviously a month ago as well. So we're looking at now 1 to 2 rate cuts, first rate cut coming in September. But we also have, if we look at Forex Factory's calendar here, we have a jobs number tomorrow. Unemployment rate, employment change. This is the Canadian, US dollar here. We have employment situation coming up. The numbers on Wednesday with ADP were relatively disappointing. What if we see a tick up in the unemployment rate? What if we see less jobs created? What if we see less average hourly earnings than is expected in terms of growth? Well, the Fed wants a softer jobs market, right? They want less earnings growth. They want less jobs added. They want to be in the position to be able to cut. That's what they do. They're a private bank given monopoly power. So at the end of the day, that's really what's wanted. And so this helps them accomplish it if the jobs market weakens and the average, the earnings outlook in terms of earnings wage growth diminishes. It only helps their case for wanting to lower rates. And so again, as we look at this tomorrow, this has a chance of moving the market positively on bearish news. Why? Well, this only feeds into the notion that we're in a position for the Fed to cut and maybe cut earlier. So what if the jobs market comes in softer? Again, watch out for the dollar's move. The problem is we're so far beyond rate cuts really helping the economy, right? All we're likely going to do is probably cause commodity prices to rise. So as we've seen the last couple of sessions with interest rate cuts by the Bank of Canada and the European central banks, how does that affect gold? Gold being the anti-dollar. Well, today gold was up 0.74%, finishing near the high of the day. In fact, during my session yesterday, we walked through, yesterday, we walked through bullish trades in GLD and Mara, looking at maybe a little bit of a squeeze here. We faded in Mara, but GLD is primed in this circumstance, right? If we're seeing sluggish growth and expectations of Fed rate cuts, this is the scenario where gold should outperform the S&P 500. At least that was the discussion yesterday. Up 0.74%, the S&P's flat on today's session. Technology didn't even lead today. It was actually cyclicals kind of bouncing back a little bit with companies, for example, like Nike up 1.4%. And others. You'll look at PayPal up 5.4%. CRM bouncing back after its big gap down. PayPal is a company we talked about last Thursday. I spent part of my hour on TheoTrade looking at the fundamentals, looking at the growth prospects, finding that PayPal is a blend of growth and value. And we've seen multiple days of bullish call option activity in PayPal. And today, it's not an exception. So today in PayPal, we saw June 26 options out here, calls being bought. So it's not just commodities, but the point is that we're kind of adding to the previous. This was added yesterday. This is added today in PayPal. And again, we'll see at the end if open interest. But again, it looks like we're probably adding 3,400 contracts to the pile at the 65 strike. So point being is that we're looking at what? We're looking at gold outperforming the market as a result of a weaker dollar, not a stronger market, not a stronger economy. The fact of the matter is cutting rates does not strengthen the economy. It just expands maybe the access or the availability to debt. The problem is that Joe Sixpack is swimming in debt right now, right? They can't even service the debt they have. Cutting rates a little bit may impact long-term rates slightly. We're seeing the 10-year today is down about 0.19%. We've seen a little bit of a pullback as we've kind of been pricing in over the last week, additional or more likely or additional rate cuts. But the reality is this can only go down so far, right? The current Fed funds rate's 5.25% to 5.5%. Maybe of a shot at getting down to 4% if we're really eminent in terms of cutting. We may see a little bit more strength in the bond market in the face of that. But at some point, we're going to start to see the inflation monster begin to rear its ugly head again. And this is not a sign of real growth or progress. It's only a sign of devaluation of the S&P, devaluation of our currency, which artificially lifts stocks. In fact, let me show you here. I'm going to go SPY plus GLD. We're taking a ratio of the two. If we look at the S&P in gold terms, okay, it takes 2.4 shares of GLD to buy 1 share of SPY. Notice what happens. This is the exact same level, the exact same relative strength or relative exchange rate as we were back in, for example, June of last year. It similarly took 2.4 shares of GLD to buy 1 SPY. Gold is a proxy for the dollar, right? If the dollar goes down, GLD goes up. So what we see is that in real terms, the S&P is at the same level it was a year ago, approximately. So if we look at SPY in dollar terms, you're saying, what are you talking about? The S&P was at 437, 440 last year at this time, right? A year ago. The S&P is at 534. We're up 100 points on the S&P. No, on the SPY. We're not actually. We're up in nominal terms. But when you consider the effects of the weaker dollar and inflation, which helps support the S&P 500, we actually have a scenario where virtually all the growth in the S&P 500 over the last year is purely about what? The weakening of the dollar as a currency. It's about inflation. And the problem is that over time, the S&P's not done a great job of keeping up with inflation in gold terms. In fact, if we're to look at a little bit different view, SPX plus /GC, we can look at this over time because the futures contract for gold goes back a while. We're going to go back max available. We'll go monthly. We'll go okay. And notice, right, if we look at the exchange rate, this 2.4 exchange rate shares of, or in this case, it's going to be 2.2 exchange rate today. Guess what? Gold bought the same number of shares of the S&P 500 back in 1997. So what does this mean? The value of the market in real terms, in gold terms, has not increased for over 25, almost 28 years, right? What is this, 1997? It's about 27 years. Think about it for a second. That's kind of crazy to think about. When you think about home prices and other things, right? I mean, the S&P, yes, it's gone up in nominal terms, but when you actually account for the devaluation of the dollar, we're not up a whole lot. Yes, we're off the lows from 2010, 2011. But if you bought, for example, in 2005, 2006, for example, you've made nothing, right? In terms of if you had to buy it, you invested money in the market in 2005, 2006, and you pulled that money out of your account thinking you're going to buy more home today with your earnings, your gains in the S&P 500, you're not buying a bigger home today. You're probably buying a smaller home. I guess we shouldn't say smaller or bigger. It's going to be a cheaper home, right? The idea is you did not make money in real terms in the S&P 500. This is the effect of monetary policy, right? It's only a function of expanding debt, making it more available, and potentially at cheaper rates. It does not create growth. And so as we're looking at the short-term dynamics of gold, this is certainly one of the scenarios and the thing we kind of talked about for a while, but specifically yesterday, and discussing how the money call spread in gold, GLD specifically, at 220, 220, 250, we're just kind of entering that zone here. This is what we're looking for. We're looking at stuff like, let's just take a look at /GCL. So for example, product depth, we can see that the oil futures curve is in backwardation. It's been in this way for a while, but the stronger dollar in the market last week caused it to kind of break support here. Now look what's happened. We bottomed yesterday. We're up today. Why? Are we suddenly at great footing in terms of the oil market? Not exactly. We're probably exactly the same as we were. But what's changing is the dollar's weakening. And so as we look at /CL or XLE, or if we get even more upstream, let's say XOP, these are your producers, right? Oil and gas exploration and production companies. We're kind of setting up here for a potential rally because of the higher oil prices. Now, higher oil prices and potentially weaker gasoline prices does not help a stock like VLO unless we start to see a rebound in gasoline prices as well, which we've seen the last couple of days. But the point is we look at the opportunity in the oil space. If oil prices continue to rise on a weaker dollar, again, we're looking at XOP. Previously back here looking for a breakout here, we got to kind of redraw these lines given the current extent of the selling. And we might look at kind of shave some of these off. We might be looking at a similar kind of a falling wedge type formation that we're not quite as close to the apex here. So I'm going to activate the drawing. It's not perfect, but it's not bad either. Again, we've got some consolidation that broke down. We're kind of touching the outers, but if we break through here, we're looking at a retest of the prior high at about 162. So point is, watch gold, watch oil and energy shares. Let's look at /HG. What about copper? Copper took it on the nose. Does copper start to base and flip around here? Now, again, it's all dependent on what? A weaker dollar. Again, we need to see more data, and more data might be the jobs number tomorrow, fueling a dollar sell-off if the jobs come out weaker than expected, and the interpretation is the Fed's going to cut sooner and the dollar weakens as a result. Yes, the S&P might go up, but it may not necessarily be the best performing, and it likely is not going to outperform gold. but /HG. What about stocks like FCX? They're coming off support again. Stronger dollar kind of caused commodity prices to slip here in many of these companies the last couple of weeks. Are we now close to reversing that scenario? Again, draw a line across the highs here. Can we break out in FCX, which is kind of a diversified miner? Yes, that's a real possibility. When you think about commodity countries, right? Emerging market countries. EWZ today off of some significant lows. I'm going to clear the drawing set so we can still be easier. Coming off the lows today. Now, this is something in the last couple of weeks we've been kind of talking about going back to this point here. There's been a number of bullish option trades in energy specifically. Okay. Now we're seeing the bounce today in EWZ. If we combined copper and emerging markets, EROs kind of in that mix there, along with FCX. Again, not being a foreign company, but ERO is a foreign country, mining in is that Mexico, I believe? Let's go to the Analyze tab here. I forget. Fundamentals. Mining projects in Brazil. So this is a Vancouver, British Columbia company, but they're mining in Brazil. Gold, silver, copper as well. So again, I kind of throw this in the basket of a copper stock, but again, we're coming off our lows here. Sometimes you see selling, right? And then all of a sudden the buyers start to come in. You can look for short-term moves in these kinds of stocks. Well, what does that mean for like China, for example? Well, emerging markets, EEM, this is largely weighted towards Chinese companies. Today we got a bounce and a drop, and we kind of bounced yesterday. We're up today. We're kind of breaking through the highs here. We could be readily looking at a retest the prior high at 44. Great thing about a lot of these emerging markets is that their volatility skew is actually generally beneficial. Let's check it here. 16.63. You got to kind of get out here a little bit. It's a little funky with the wider spreads in EEM right now. But again, you sometimes can see rising call volatility out here, which you're kind of getting. It's a little back and forth because the spreads widen out here towards the close. But again, sometimes you see rising call volatility. Again, the bid-ask spreads are kind of awful right now for EM. But let's look at EWZ. Oftentimes you'll see lower volatility starts to pick up as you move out of the money. Again, very similarly, really crazy spreads here after the close. Again, you can kind of watch these tomorrow. Again, normally if you have rising call volatility as you move out of the money, creates a cheap call spread. You buy the lower strike, sell the higher strike, kind of play these out here to the upside. Petrobras was one that about a week and a half ago, saw some long call activity. Again, energy, we're talking about, drilling for oil, et cetera. It's a Brazilian company as well. We're kind of basing down here. So these are companies to watch that a weaker dollar, if it causes a rise in oil prices, rise in commodity prices generally, this should help these stocks in particular. Now, it doesn't mean these are the only stocks moving out here, right? For example, we talked about PayPal, and again, the big breakout we saw today. The spread I outlined last week, you could close it today for 100% gain with today's move. Again, there is opportunity, and again, further opportunity probably in PayPal. We're looking at the 161% target up here, about 80. It might take weeks to months to get there. But then we see companies today like Nike. Now, Nike might try to lump in like with a PayPal, for example. Stock gap lower. We're kind of closing above the high of the gap day today. But when you actually analyze the fundamentals on Nike, you realize we got earnings coming up here. Significant. This is going to end the fiscal year. Reports for Nike, the 2024 fiscal year, we're on to 25. They've had significant earnings, negative earnings revisions. The profitability is not the same as other companies. The valuation's not the same, despite the fact the stock's off its highs. So there's a lot of work to be had here on the earnings. They've got to beat earnings and revenues, guide higher, and see the stock price go up. And we concluded that there really wasn't a great trade in Nike not having those numbers and the fact they're coming up soon on 627. So hold back and wait. Nike today, there was buying on the SEP 100 strikes, SEP 100 strike out here, for example. But again, is it worth it? $100, $5, we're talking 5% move. It's better off to wait and see if the fundamentals change for the better or much better. There's a chance they actually change for the worse. Valuation is not a great story. The profitability, the outlook, none of it's really lining up, but we're seeing option activity today. So we're seeing strength in consumer cyclicals like in Amazon. Well, Amazon, we can maybe retest our prior highs here at 190. But again, what does this mean if the Fed's looking to cut? We're seeing more of immediate strength in commodity names. So the focus predominantly is more about what? It's more about just playing the commodity play. I mean, that's the most natural. For this late that the Fed has to cut rates to stem off a recession, you might say, well, yeah, but real rates, if we look at the TNX, the 10-year treasury yield is way higher than the projected inflation rate. I get that. And they're saying, well, they got room to cut. Yeah, but look, I mean, the fact that we're seeing a coordinated effort to cut rates by Bank of Canada and European Central Bank, I'm assuming there's coordination there. There generally is, that there's easing going on. The Fed's probably likely to follow suit. And it's not about the fact we're in a great position and that we're really handling inflation. This is the time where we can really cut when we're experiencing inflation rates that are still well above trend, above the Fed's target of 2%, which in of itself is crazy and immoral that they can target that. But anyway, I digress. So again, as we look at EWZ, option activity today, again, we're seeing some bullish long call activity in EWZ. It's the 14 June 30, so it's next week's expiration. On EEM, the call activity is 14 June 43, just out of the money here. And also, let's take a look at a precious metal stock and wheat and precious metals, WPM. Nice bounce today. Volume wasn't super high, but wheat and precious metals, we could look at this retest the prior high at 58. We're seeing that June 56 options traded today. So again, we start to break through, could push that back to 57.50. I mean, what about an at the money here? Let's look at the strike selection. Let's go to the 36 days. Again, spreads are just okay in here, but 56, 58, buy deep and wide, 1 month, 2 strike vertical. 58, 56, 58 is the skew favorable, buying lower, selling higher. 73 cents on a $2 spread. You break even at 56.73, which is right here. Get to 58. Again, that pushes you through. Get above 58, you can close it out. But this is a relatively cheap spread. And if you can sell it for like $1.25, $1.30, great. Close it early. But this is an example of putting skew in your favor and kind of taking today's activity and where the option trade is happening as an opportunity. So we'll kind of wrap it up with that. But again, we'll kind of key off. Join us tomorrow live for our Theo live event. We kick things off at about 45 minutes before the market opens. Go about a half hour. Feel free to join us there. We're going to kind of replay the jobs numbers. We're going to look at the impact on the market and look at some opportunities they're setting up in the face of that. And it will catch you tomorrow. Thank you.